Morning.
As we all know, markets tend to overshoot. And it seems recently that markets seem to be recorrecting or readjusting their expectations on growth, recovery, and earnings. What do you think is happening, and would that essentially mean more downside over the near term in equity markets?
Well, the last variable that you didn't actually mention there is, of course, inflation. And that, I think, is really what investors, especially on the fixed income side, are absolutely focused on. We had the March data release in the United States where we had the pickup in inflation. We're going to see the same probably in April, May. And then the million-dollar question is this inflation pickup really going to be transitory, as I think we all hope it will be, or are we going to be in store for much higher price increases? So that, I think, is a source of where you get the jitters in the fixed income markets, which can then potentially spill over into the equity market.
And your experience, of course, within fixed income, is there anything right now in the fixed income space that tells you this inflation coming through the system these next 2-3 months, is there any permanence to it?
That is really such a tough question. I mean, if on balance, I would basically still say that is it a transitory, largely base effects driven phenomenon. But I mean, look at things like lumber prices, copper, etc. I mean, the commodity space is really on fire at the moment. And then there's always a risk that spills over from commodity-based inflation, headline inflation back into core if that extends for a longer period of time. So I think that, the jury is still out on that. But as a baseline view, we're still recommending to investors, look at this period as a transitory one, focus more on equities than fixed income, and focus, of course, on COVID-19, which generally speaking is moving in the right direction.
Stefan, it's a bifurcated world, isn't it, when it comes to the vaccine rollout and the impact of the virus? You only need to look at India and compare that to what's happening in terms of the UK or the US. How do you weigh all of that up when you're making your investment decisions? You favor equities at this point. Which regions or which nations, which countries do you favor at this point?
Yeah, that's a very tough story because exactly as you said, we have these two extremes. We have the UK, the United States, and Europe is picking up pace. Obviously, China has managed the COVID extremely well. And then we have selected emerging markets like India and also Brazil, where you have a really very serious humanitarian issue on the ground. Now, in general, what we are saying to clients is to focus on mature markets over emerging, largely because regions like Japan and Europe are more geared towards the global reopening, reflation, and recovery process because of the high component of cyclically sensitive exports in those indices.
Is it too early to buy the dip in a country like India?
I would say, unfortunately, yes. I mean, we really want to see more signs that the healthcare system and the sort of the economy at large is coping with that very severe crisis that they have in India at the moment. So I think unfortunately, it is a little bit too soon.
And what about Japan? Because as you point out, that's one of your favorites along with Europe. We've seen that market wobble slightly. We're, I think, at the bottom end of your 2-3 month range. Do you think that's just a normal sort of rotation in these markets, or is there anything you're watching more closely in Tokyo?
I mean, you have some really surprisingly strong data points coming out of Japan as well, like the Reuters Tankan sentiment indicator lasted a few months, has been really quite exceptionally good, notwithstanding also, I think the authorities in Osaka and Tokyo are asking for states of emergencies to be declared. So that they're also not out of the woods. And Japan has also been relatively slow in vaccine rollout compared to the G4 peers. So it's not a completely straightforward story there. But in general, the corporate sector seems to be very confident, and we take comfort in that.
And that's a good starting point, of course. You mentioned fixed income, Stefan. Anything interesting there?
Well, in fixed income, I mean, it really in the let's say the next sort of 3 to 4 months, the volatility which we think is going to increase for government bonds is going to make it more challenging for investors. On the other hand, the global recovery should continue, so there should be room for spread compression to come through as well. On average, though, or on balance, I would say that, risk-adjusted basis, you can make arguably still more money in equities versus fixed income.
How are you hedging volatility at this stage?
Also, very good question. I think that, I mean, one thing to look at in a very sort of simple way is the materials sector. So, you know, if you believe that, you know, we have inflation surprises around the corner, more shaky markets, but strong inflows into the commodity space, materials and mining equities, that is something to look at. It's performed relatively well over the recent past and should have actually some pretty good momentum behind it. Alternatively, for really those investors who are very risk averse, lock in some of the gains that you've made so far this year and just sit out these next sort of 3 months.
What about taking it a step further for, I guess, investors who might have a little bit more risk appetite? What do you think about just going long vol?
Yeah, that absolutely would make sense as well. I mean, for very risk tolerant investors, we do argue across all asset classes the volatilities are going to increase. Again, I think largely going back to that very central question around inflation, which for the G3 economies has been largely been absent for a very, very long period of time. We're all waking up to a world of higher prices, and so that is definitely something that has to be taken into account.